Michael, thank you so much for joining me. The news story has taken a turn today, and of course, this second deadly attack that we see at the Capitol in just a matter roughly of 3 months. The market's closed today for Good Friday, but do you anticipate on Monday that investors might be taking this into consideration, the second deadly attack in just 3 months?
You know, I think first, I think we all should express our deep gratitude for the sacrifices that the Capitol Hill police make to keep the seat of our democracy safe. And I also think we're all regret that their job has clearly gotten much more difficult in the last little bit. However, having said that, I think that the roll call reporter really hit the nail on the head when she said that tragic as this was, and unfortunate as it was that an officer paid with his life to stop this attack, a lone attacker will probably not rise to the level of a threat that would cause a market reaction. I think the non-farm payroll is going to be far more important in how markets open up on Monday than this tragic incident.
Well, we will continue to stay on this tragic incident. I do want to get your take on the jobs report, considering that this is a market segment. We do see the 10-year Treasury yield, the bond market open for a half day today at 1.71%, a little bit higher than the prior day, but not as high as that recent 14-month high of 1.77%. What is your reaction to the jobs report this morning?
I think the Federal Reserve got exactly what it was hoping for. Obviously, the number was extraordinary if you kind of average February and March, because February was probably depressed by weather. March was probably boosted. Across the 2 months, it's about 700,000 jobs per month. That's spectacular. But remember that the Fed Chairman Powell made it crystal clear in his congressional testimony, and Janet Yellen echoed these comments, that they're not going to worry about inflation until we've replaced the 9 million jobs that we lost to COVID. And that means we could have a year of job gains like this before they would be thinking about taking their foot off the accelerator, and long before they'd be thinking about transitioning onto the brake. Meanwhile, you've got the best possible news on inflation because, yes, the wage gains were big, more than 4%, but they were distorted by year-over-year comparisons and the fact that high-wage manufacturing jobs have come back faster than low-wage services. And the 1 month number was negative, which means that the Fed got a huge support for them saying that there isn't yet an inflationary problem. Keep the pedal to the metal. I think that's going to be
interesting. Michael, when you bring up inflation, because certainly we saw that much better than expected ISM manufacturing data earlier this week, the highest read and best growth that we had seen, that is since going back to the 1980s. So in certain sectors of this economy, as has been the case, especially if you're buying a home or going to fill up your car at the pump, we are seeing inflation in certain sectors, but it didn't show up in wages. Wages actually down month over month from March to February by 0.1%. Is that worrisome that as pockets of this economy really do see inflation rising, that wage figure isn't higher?
Well, as someone who's renovating a house right now, I can tell you there is huge amounts of inflation in the construction industry. But what the Fed is definitely hanging their hat on is that wage gains are what ultimately will drive long-term inflationary pressures. Yes, we've got isolated pockets of the economy that are definitely seeing inflation, but wage gains are what create that systemic inflation. It's wage gains that created the 1970s systemic inflation. And as long as we're getting a negative number off the wage gains, the Fed can't possibly be concerned yet. And you ask yourself, why would wages possibly not be rising faster right now? And I think part of the reason may be in where the jobs are really red hot. In manufacturing, in construction, what I call the stuff economy, a lot of the new workers don't actually have the skill sets to do those jobs yet. A lot of them are coming into apprentice programs and so forth. So they may be at a lower than average wage right now, but they're in a position that a year from now, they could be into a middle-class lifestyle because these are great jobs long-term.
How important is it that this leisure and hospitality sector that has been hit the hardest by the pandemic, especially when it comes to jobs, still more than 3 million people in this sector without of work, even a year later, how crucial is it that it was the industry for the second straight month that did see the biggest job gains, even though, again, still collectively, it is down millions since the start of the pandemic?
I think it gives you real hope that maybe by the summer, maybe by the fall, the combination of vaccinations and all the stimulus that is coming into the economy, and then let's add a third leg that savings rates are at the highest levels we've seen since the 1950s. So take all those three together, and you've got tremendous pent-up demand for those services. And I think there's been a tremendous amount of damage done in that sector. As you noted, 3 million jobs lost that we haven't recovered yet. I think what we're seeing in the last couple of months is glimmers of hope that in the next 6 to 9 months, you could see a real healing of those sectors. And some of those people who have suffered so much economically in the COVID shutdown, while so many of us have benefited, they will finally start to be participating in the economic recovery.
Mm-hmm. Now, does it worry you at all that the wild card in this equation is that COVID cases are on the rise, even as the economy reopens, even as the vaccine rollout ramps up, even as the weather warms up and more restaurants can partake in outdoor dining? COVID cases are rising. What sort of threat does that create?
So for right now, we're looking at that as indication of COVID fatigue. People, you get close to the finish line and you get careless. And I'm actually seeing this as I look around me, going out in my daily life. People are getting definitely careless, and they are getting a little sloppy in terms of maintaining social distancing and all the things that help lower infection rates to begin with. We also have some very scary, much more infectious COVID strains that are also driving this. But for the 6-month view, the 9-month view, not the next 6 to 9 weeks, but the next 6 to 9 months, the important thing that came out this week from Pfizer is that their vaccine is 90% effective against the new variants, which gives me hope that the Moderna vaccine will also be effective. And the Johnson & Johnson vaccine was actually tested while these variants were very much in circulation. So the important thing for the 6 to 9 month view is, do the vaccines work against these new variants? And the message we're getting is absolutely they do. And that, to me, yes, there'll be a spike where people are getting careless. Ball fields are opening, movie theaters, there's going to be a spike. But the 6-month, 9-month view is these vaccines are going to work. And that means that we're going to reopen.
All right, Michael, thank you for joining us on a very busy news afternoon on this Good Friday, even as the markets are closed. That's Michael Jones, Caravel Concepts Chair and CEO.